We have seen an unprecedented rally across the entire precious metals complex. Gold, silver, platinum, and palladium have all experienced significant price appreciation. That was driven by a combination of geopolitical instability, a weakening of the US dollar, and growing concerns about physical supply shortages. Gold smashed records, trading not only above $5,000 an ounce, but above $5,500 an ounce at one point. It's now about $5,180 as I speak on this Friday morning, while silver has seen an even more explosive move, surging past $100, $110, and then past $120 at one point. So as of late January, registered silver inventories on COMEX, which is the only silver available for immediate delivery against future contracts, covered only 14% of the paper claims. So that means there's 7 claims, at least as far as the futures are concerned, on every actual physical ounce. So you only need 1 in 7 to demand their silver, and it's all gone. At the press conference of 28th of January, 2 days ago, Federal Reserve Jerome Powell was directly questioned about whether the parabolic rise in gold and silver prices indicated a loss of US credibility on the world stage. Powell dismissed that notion, stating, "The argument can be made that we're losing credibility or something, but that's simply not the case." Well, that's his opinion, and of course he was put on the spot by the question, so he didn't have time to think of a better answer. But clearly, if the price of gold is going through the roof, it means that the dollar is losing its credibility, because obviously the dollar, as we see on the looking at the DXY index, is now once again falling sharply after falling about 10% last year. So Jerome Powell said that he pointed to the anchored inflation expectations as proof of the Fed's standing, and he asserted that the central bank doesn't take macroeconomic messages from the metals rally. Obviously, that's very much in contradiction with Alan Greenspan, who regarded gold as one of his primary indicators as to whether everything was working, and a rising gold price. Don't forget, Alan Greenspan was a former Federal Reserve chairman many years ago, and Greenspan would say a rising gold price is a reason we have to be worried. We have to look at what we have to do. Jerome Powell appeared not to be concerned by the gold price, and more importantly, when he was asked about the falling dollar, he again really said that's not our concern, it's the concern of the Treasury, which spooked the markets a little bit, because after all, the Federal Reserve, of which he's in charge, is the issuer of the US dollar currency. So to say that it's not really your concern when you're the head of the biggest country in the world, the world's reserve currency, and you're the issue of it, obviously got a few major players a little bit spooked there. In the first week of January, there was a 33.5 million ounce withdrawal from COMEX, representing 26% of the registered inventory vanishing in that week. And what I'd like to say to everybody is watch out for the month of March. The number of open contracts, or the amount of silver represented by the open contracts, is massively in excess of what is deliverable at the moment. Now, between now and March, those contracts might get closed, but the last time I looked, which was yesterday, the number of open contracts was not closing or reducing, it was rising. So if the majority of those buyers of silver contracts for March demand delivery, the silver doesn't exist at the moment. And that's a fact. The reason for the silver surge has been rumours or stories of a very severe short squeeze on COMEX. Bullion banks who've been shorting the silver market, which is a traditional way of making money. You sell the contract 3 months forward, wait for it to come to maturity, buy it back at spot, and sell again the futures contract 3 months forward. That's a guaranteed way of making money because of the contango. Means the 3 month price generally trades higher than the 1 month, the 0 month price. So by selling 3 months forward and then buying back when it gets to 0 month, you lock in a profit each time. But the trouble with that is if you're a short and you're expected to deliver the silver that you don't have, you've got to lay your hands on it. You might well have the silver, but if it's in the wrong place, let's say London instead of New York, or it's in the wrong shape, in other words, it's not deliverable bars, whilst you might be financially covered, you're going to have to try and buy the right size, right shape, physically deliverable bars on COMEX, and that might be what you've got trouble getting your hands on. So that could explain the short squeeze going on in COMEX. And it's significantly more than the registered silver available for delivery. So there's a precarious situation where some of those shorts, as a part of their risk management, are starting to close their short positions, further triggering or pushing up the prices. As far as forecasts for where gold could go and silver could go, we're now seeing forecasts start to come out with the possibility of $6,000 gold. And we're halfway there at one point when we were 5,500 in just the first month from 5,000, and talk of silver going to $150. This is talk of it getting to these numbers in the short term. By the short term, I don't know what that means, but next month or two is what people are saying. Of course, these are just forecasts, and we know that forecasts are always wrong. They're either too high or too low. As for the gold price forecasts, what are we seeing? We're seeing UBS forecasting 6,200, Goldman Sachs 5,400. Well, I don't know when they forecast that, but it passed that a few days ago. Deutsche Bank $6,000, Societe Generale $6,000, Morgan Stanley $5,700 in a bull case. And these are they're called 2026 gold price forecasts. Analysts are saying that this tightness in the physical market is likely to continue. Citigroup, for example, has been very aggressive. It's raised its short-term price target on silver to $150 an ounce, which kind of implies another 40 to 50% upside in the coming weeks. Now, another factor affecting the gold price and causing it to rise so much has been President Trump's aggressive use of tariffs. So since his inauguration, the price of gold has jumped by about 90% since he was inaugurated about a year ago. And these threats of sometimes up to 100% tariffs on Canadian goods, for example, and a stated desire by him for a weaker US dollar, but at the same time saying a strong dollar, so a bit of a contradiction there, a weaker dollar whilst the dollar remains strong, to boost domestic manufacturing. And that basically this sort of flip-flop has created some sort of uncertainty. But if we look at the numbers and listen to what the market is saying about itself, the dollar has fallen to a 4-year low. It's lost 10% of its value in 2025, and it's continuing to decline in 2026. So what we've got going on is potentially what's called the debasement trade. The debasement trade is where investors flee from fiat currencies to the safety of hard assets. So the old narrative of gold keeps up with inflation and it'll buy you the same as it bought 10,000 years ago, 2,000 years ago, 500 years ago, or yesterday, and using gold as the inflation hedge has kind of gone away. Now people are looking at more as what could go wrong in the future. So they're kind of front-running the unknown, and the unknown for them is something far more serious than we're seeing at the moment of a rapid decline in the dollar. They're seeing something more serious than that. So they're whatever it is that's coming, they don't know. We don't know. Nobody knows. We've got some ideas on what might happen, but I think people are starting to front run that by buying gold. And amongst the most voracious buyers of gold have been the central banks. The statistics from central banks are always heavily lagged, but there's many months of delay from some of them, and some of them don't even report the numbers at all. But so far, what's reported, we know that in 2025, collectively, they bought 863 tons of gold. I guess more numbers are going to come in showing that number creeping upwards, and the trend is expected to continue, the trend of central bank buying in the current year. There are also deficits at the moment in the platinum and palladium markets, where the demand for industrial use, particularly the automotive industry, exceeds the mine supply. And the mine supply, mustn't forget, is very precarious because all of the platinum and palladium comes from only two countries, or mainly two countries. One is Russia, which is sanctioned, and the other one is South Africa, where there's always going to be a worry of political instability, and obviously workers asking strikes and things like that, asking for more money. So there's a sort of worry that if we get into a strike action, say in South Africa, the supply of platinum and palladium might dry up for a while, and therefore users of platinum and palladium are starting to stock up to make sure they've got a supply to keep themselves going through a dry period. We've seen this massive drain in January of 33.5 million ounces going out of COMEX. We've got a little bit of a backwardation now in the silver market, where the futures prices are starting to be a bit below the spot prices, which indicates that the demand for immediate delivery of silver is higher than the demand for delivery of silver in 3 months' time. But that could also be a sort of warning that the silver price might decline as time marches on, because if the futures price is lower than the spot price, it means the demand, people are trying to buy now and not in 3 months' time. So, just to finish off, we've got this unprecedented period, January 2026, where we've seen one of the most volatile periods ever in history, perhaps not the most volatile, but certainly one of the most volatiles for gold and silver. We're seeing this strong demand in the light of the geopolitical turmoil, the weakening dollar, supply shortages. Obviously, there's a concern that something might be going to happen at some point. We don't know if it's days away, weeks away, months away, years away, but we all know the word global currency reset. We know it's coming at some point. It's going to come for most people long before they take their retirement, and they've got to be doing something to have something which is at least outside the system so they can get their hands on it. And whilst there's other options like property, many people are choosing to turn to the most liquid of all options, which is gold and silver, because you know that in a crisis, when people don't want your money, everybody's going to figure out very, very fast what an ounce of gold or what an ounce of silver will buy, and you'll have no shortage of people who'll want to take it off you. Even if there are governmental restrictions, everybody's going to want it.